Hello and welcome to today's webinar. It's a series of presentations that we did in February of this year on the road. And if you weren't able to join us on the road, well, welcome today. And the session that I'll be covering is really having a look at the value within investment chains. Investment at its heart ought to really be very, very easy. Ultimately, you've got a group of people who are typically your customers who have got too much money. Now, I appreciate they probably don't tell you that they have too much money, but by definition, anyone who's accumulated more money over their life than they've ever spent ends up with something called savings. And some people end up with so much savings that they actually want to put those savings to better use than just leaving them on a bank deposit. On the other side of the economy, there's a group of businesses and companies and people with ideas, entrepreneurs really, who are looking to raise capital. And so you've got people on one side with excess capital and companies on the other side of the economy who are looking to raise capital. And the job of the financial services industry is really to put those two people together. It's to intermediate the savings of customers and allow those savings to be directed towards viable investments and viable ideas for the future. That's the role of the financial services industry. And of course, the customers get the return on those investments by way of rewards for taking that risk, but they also receive a bunch of other services in that process as well. So ranging from your fund manager at one end of the value chain who will look to choose whether you should invest in Facebook or Apple or BP or Shell for that matter. Those fund managers perform a role. But if you're doing this on a global basis, and also particularly if you're doing this on a multi-asset basis, you'll also require that the assets are allocated in some sort of way. Typically, it's a combination of strategic and tactical asset allocation, and also that multi-asset manager will also tend to be the person who chooses from the thousands of fund investments that are available to you. Of course, all of those investments have to sit somewhere, so that requires a custody and administration platform. And at the sharp end of things is advisors like yourselves who are responsible for financial planning and tax advice. Now, of course, these days in a post-RDR world, the technical knowledge that you guys have is almost a given. That financial planning and tax planning advice is very much a given. And more these days, it's the investment advice and more softer skills such as behavioral coaching by customers based on studies that the likes of Vanguard and Morningstar have undertaken with customers. Those softer skills are actually the parts of the value chain that the customer really places value upon. Now, when you're building these value chains, there's a number of different models that you might choose to use. What we're going to do today is have a look at some of the more prevalent use value chains that people use within their practices when they're intermediating between customer savings and investment markets. The first one is probably one that you're all familiar with. You'll either currently be doing this in your practice, or have certainly probably used this in your practice in years gone by. And that's the practice of using in-house advisory model portfolios. Now, of course, what you'll see here is one of the piggies has been removed from the value chain. And what that means is, as a financial advisor, in addition to the financial planning, investment advice, behavioral coaching, you're now also responsible for strategic asset allocation decisions, tactical allocation decisions, and including the fund selection. So actually choosing the fund managers who will go out and do those end investments and store them on your custody platform of choice. So that's one that you're probably most familiar with. Now, for a number of advisors, and increasingly a number of advisors these days, more and more people are looking to outsource their investment functions. So we'll take a look at some of the outsourcing options that are available to you. First one, which is perhaps the one that's got the longest history, is an outsourcing arrangement to a discretionary fund manager. These DFMs will typically be what would have been termed stockbroking businesses in the past, but of course they've evolved over the years into wealth management businesses, private banks, etc. And what happens in this situation is you'll partner up with a DFM of your choice, and they'll take on all of the investment work, strategic, tactical asset allocation, fund selection, etc. But what they also tend to do is they will also bundle their custody solution for you as well. These DFM businesses typically have been going for, in some cases, 200 and 300 years time. And as a result, they've built up their own back office functions. And when you partner with these businesses, they will bundle not just the investment solution, but also the custody solution as well. And in more recent years, over the past 10 to 15 years in particular, we know that more and more advisors have moved to an independent platform custody administration solution, AJ Bell, Transact, Aviva, you name it. And as a result of that, the bespoke DFM model sometimes doesn't tend to work, and you'll also want to have control over what custody and administration solution that you're using as well. To fill this gap, the outsourced model or managed portfolio services came along really in the past decade or so. These MPS providers really focus now on the investment management part of the operation, strategic capital asset allocation and fund selection, and you're in control of which platform those assets sit upon. And so you're now taking more control over that value chain and really just buying from your outsourced investment provider the parts of the value chain that you really want to get your hands upon. And the fourth model that we'll take a look at is that of multi-asset funds, where effectively, and I'll just swap between model 3 and model 4 there. So you've got your outsourced MPS provider and your multi-asset funds, and you'll see nothing really changes in terms of the functions within the value chain. But what you do see is you see a change in the vehicle with which those investments are held upon. In the outsourced MPS model, you get a look through the vehicle and get to see all of the underlying securities and funds within the portfolio. Whereas in the multi-asset fund world, you lose that element of transparency. But what you do get in return is you get a more structured vehicle to hold those investments, and it does come with some tax advantages as well. So now that we're familiar with all of the models that we're going to consider, what we'll first of all do is we'll take a look at which of these models are most prevalent of use within advice practices in the UK. And then what we'll finally do is we'll run through each of them and just take a look at some of the pros and cons of each of the 4 models, and maybe spark a few thoughts around which is the most appropriate model for your own individual practice. So here we've probably got a scene from your investment committee, decide when you should be overweight or underweight Europe. But really what we want to do here is just have a look at which of the 4 models that we've just described are in use around the industry. We took a survey of AJ Bell platform users when we were out on the road back in October 2019. And the 4 models that we've just described there, when we asked the 300 or 400 advisors who came along to those seminars, which of those 4 models do you tend to use for a client in accumulation with £150,000 to invest? These are the results that we saw. So what you're seeing here is about half of all advisors who use the AJ Bell platform tend to use their own advisory model portfolios as their preferred investment option. Around a quarter of advisors will use multi-asset funds. Around 1 in 6 will use a MPS provider on the AJ Bell platform, and about 1 in 20 will look to outsource to a bespoke discretionary fund manager. So what we're going to do now is just take a look at some of the pros and cons associated with each of those 4 options. And we'll start where probably most advisors feel more comfortable, which is your in-house own model portfolios managed using advisory permissions. Now, the great news about this is when we take a look at all of these options, we'll not just look at the pros and cons, we'll take a look at some of the value and what you pay for these value chains as well. And the great news around the in-house model portfolios are, first and foremost, it's typically the lowest cost option for your customers. Because you've removed an asset allocator out of the value chain and bundled that asset allocation process with your own financial planning and tax advice, for example, because that's a bundled solution, that's typically the cheapest option for the client, and also it removes the VAT element on the investment management as well. So it is possible if you're, let's suppose you're charging 75 basis points for your complete investment advice and investment solution. It is possible to combine that with a low-cost platform and completely passive implementation. And it is possible to put that value chain together for around 100 basis points, which is exceptional value in today's markets. But of course, what we tend to see is advisors who will bundle financial planning, financial advice with an investment solution as well. What we actually see is most advisors would actually charge a 1% ongoing charge for that sort of service, which isn't unreasonable given the number of tasks that you're undertaking there. But if you put that on an expensive platform and you use more expensive investment options, it's not hard to put a value chain together here that actually comes in at an all-in cost of over 200 basis points to the end client. And this cost and value is something that we'll come back and have a look at in some of the other models as well. So lots of pros for the in-house advisory model solution. It is, as I've already mentioned, typically the cheapest option for the customer, but also as an advisor who goes out and sits with the client on an annual basis, talking about investment portfolios, talking about investment options. It gives you greater control over what's in the portfolio, and as a result of that, we tend to end up with a stronger, what we call a chain of conviction in the portfolio. You're sat in front of the client, you know exactly what's in the portfolio, but more importantly, you know why it's held within that portfolio. And so it's not unsurprising, I guess, to see that half of the advisors that use the AJBL platform typically operate on this in-house advisory model portfolio basis. However, it's not without its drawbacks. And the biggest drawback when we speak to advisors about running portfolios on this basis is it's an absolute administration headache. And I'll demonstrate why in particular it's an administration headache. Let's go back, let's say maybe 5 or 6 years when post the last suitability review from the FCA, we ended up with this new 3-letter acronym within our industry called the CIP, the Centralized Investment Proposition. And lots of advisory firms went about creating their own CIPs, and typically what we saw is most advisory firms would take their client base and they would risk rate them into probably 1 of 5 risk categories, ranging from cautious at the low risk end of the spectrum to more adventurous at the high risk end of the spectrum. You would allocate your clients, and a typical advisor firm will have about 150 clients within the practice. You allocate your clients to those individual models and everything looks fantastic. But of course, you're managing these in-house model portfolios using advisory permissions, which means any change to the investment portfolio is a replacement business exercise, which requires a two-way communication between yourself and the client in order to make any changes to the portfolio composition. Now, you will all have great relationship with your customers, but I'm yet to come across an advisor in the country who has a 100% hit rate when it comes to trying to change the composition of model portfolios using advisory permissions. The industry average tends to come in around 85%. And so let's suppose that in each of these 5 portfolios, there's one position that for whatever reason, you've met a new fund manager or you've met the existing fund manager and you've decided to change that recommendation, but you want to make a change to these model portfolios. You write out to all of your clients in your client base, and typically you'll find that 85% of the clients come back and agree to make that change. Now, it's not that they necessarily think that it's a poor piece of advice, it's just that they have lives of their own, and the letter that they receive from you isn't perhaps as important to them as it would be to you in order to get the recommendation back. And so what tends to happen is when you make your first change to your model portfolios, what we end up with is this situation where you've now got most of your clients are in the newly minted model portfolios, but you're left with a legacy range of clients who stay behind in the slightly inferior old vintage model portfolios. And of course, you don't just do one change to the model portfolios over the course of a year. Maybe over the course of a year, you might make 3 changes to your model portfolios. And before you know it, in 12 months' time, your 5 nice, neat model portfolios have now mushroomed into 20 different model portfolios with 4 different vintages in place. And before you know it, if you run these portfolios for 5 or 6 years, you'll find that your clients that were in 5 model portfolios will probably end up in 30 to 40 different model portfolios. And your back office staff start pulling faces that look like this. They're screaming at you, particularly in a world where you've got MiFID II costs and charge disclosures now. that the administrative load of managing model portfolios using advisory permissions starts to become a huge bottleneck for your practice. Now, prior to joining AJ Bell, I worked as a consultant for advisor practices probably similar to yourself. And that's normally the point where people decide maybe we should think about re-registering our permissions and move from advisory permissions to more discretionary permissions, because our back office staff, our paraplanners and our administrators are really starting to struggle with the load. Now that's the famous Munch picture there of the screen, which for anyone who's interested was also the inspiration behind the scream emoji. If you are looking to outsource, typically your first port of call would have been to go to a bespoke discretionary fund manager. These guys have 200 to 300 years of history and heritage of building investment portfolios, and they're more than happy to partner with financial advisors in order to build bespoke discretionary portfolios for end customers. Now, it can be a great solution for a number of clients, particularly clients who genuinely do have bespoke needs. And what we find these days, more and more clients are tending to have bespoke needs, particularly those clients who have a bias towards ESG kind of considerations. So if your client is looking to definitely exclude the likes of Wonga, Facebook, Amazon, Coca-Cola, wherever the company or companies may be, if you want that bespoke nature to your portfolio, a bespoke discretionary fund manager might be the right solution for that client. But the problem with this solution is it comes with a lot more cost. So you're now outsourcing to a discretionary fund manager who will typically charge between 1 and 1.25% plus VAT for the management of these portfolios. Now you add that onto what would be a typical advisor ongoing fee in this relationship of 75 basis points. And it's very easy to build a portfolio, even using passive instruments, which comes in with a total cost load of over 200 basis points. And it's also very easy to build a portfolio with a total cost load of in excess of 300 basis points. And that's indefensible. It's indefensible in a world where, particularly post-financial crisis, a balanced portfolio is likely to produce a gross return of maybe 6%. And it's unfair that we ask customers to take all of the risks associated with generating a 6% gross return, but they actually only see half of those returns themselves due to the cost of the value chain. Now, we do believe that discretionary fund managers will adapt to this well, but at this moment in time, the pace of adoption seems to be quite slow, and so we're not seeing significant cost cuts for this type of service. And as a result, we are seeing more and more advisors move away from this model, more towards a outsourced MPS option. I'll not labour the point on some of the pros and cons of the bespoke TFM, but one thing that is worth bringing out here is this relationship of agent as client. So what happens when you outsource your investment function to a third party is it's important, and we see not a lot of people take a real close look at this. It's important to understand the nature of that relationship. Most outsourced investment operations are done on an agent as client basis. Now that's important because let's suppose, for example, something happens within the portfolio which registers a client complaint. In the agent as client model, that client complaint is against you as the financial advisor, and in turn, you've then got power of recourse to complain against the investment solution provider. But under an agent as client model, you are deemed to be a professional client, whereas of course your client is typically almost inevitably likely to be a retail client. So it is possible that you end up with some nuances between those two relationships, where the client is complaining against yourself as the advisor, and you don't have power of recourse to claim against the investment manager who is treating you as a professional client. So it's important that you're aware of that relationship. That is one of the cons of some outsourcing models. There are alternative solutions. One in particular that we use at AJ Bell is the reliance on others model, but it is something that you ought to be aware of. So a more recent option for outsourcing is this outsourced MPS service, managed or model portfolio services. And as I mentioned before, what this is, it allows you to keep your investments on the platform of your choice in terms of custody. And really what you're now buying from the investment manager is the part of the value chain that you actually want to get your hands on. And as a consequence of this, because it's a lighter touch model for the discretionary fund manager, the costs in this market have come down significantly. At the lower end of the scale, you can find MPS providers willing to offer their services at around 15 basis points. And towards the more expensive end of the spectrum, you're looking at more like 40 basis points, where the industry average in this world is actually 30 basis points. And you can see here, if you are using a low-cost MPS provider on a low-cost platform and you're using passive instruments, you can build an all-in investment solution here for around 125, 130 basis points. But of course, if you're using an expensive platform, an expensive MPS provider, and using more expensive active instruments, it is still possible here to build complete solutions which come in at around more like 250 basis points. Now, the outsourced MPS world, we believe, is the future for outsourcing relationships within the advisor community. It looks and feels more like your portfolio. If you have been running financial portfolios, your clients are used to seeing all the underlying constituent parts of their portfolio, and they're used to having a discussion around them. So lots of the pros of outsourced MPS, it is outsourced and it removes the admin headache that I described before. It's much cheaper than a bespoke discretionary fund management relationship, but it retains all the look and feel of a DFM. And if your clients are transitioning from in-house advisory model portfolios, it also retains that look and feel as well. Now, potentially it does break the chain of communication. You may not necessarily know what's going on in those portfolios and why it's going on. But the biggest drawback we see in the MPS market at this moment in time is it's really difficult to do a whole of market study in order to find who the best solution provider is for your client. And also one of the other drawbacks in this is because these are managed model-based portfolios, all of the clients will end up with the same portfolio regardless of their CGT situation. And that's another reason why maybe a bespoke DFM might be the right solution for some clients. And the final solution is that of the multi-asset fund world. So the multi-asset fund world here is very similar to what we see with the outsourced MPS solution. And it is possible again to build very cost-effective total value chains. But what you have in the multi-asset fund world is there are almost 700 different multi-asset funds out there, all offering varying levels of asset allocation, tactical asset allocation, and implementation strategies. And as a result of that, that's an awful lot of research that you have to do to understand that marketplace. And also the spectrum of costs can be really at the lower end of the market, the likes of Vanguard Life Strategy, you can get a multi-asset portfolio for around 20 odd basis points. Or if you go to the more expensive parts of this world, the Jupiter Merlins, for example, you're paying more like an all-in cost just for the multi-asset fund itself of closer to 2.5%, which if you then put on an expensive platform and add in your advisory cost, you can see now it is possible within the multi-asset fund world to build a complete cost chain, which is even more expensive than the DFM solution that we talked about earlier on. So you have to be very careful around which of these options that you're using. So hopefully that's stimulated a couple of ideas and discussion points where your own practice around which model that you're currently using or potentially future models. And if it is just prompting some of those discussions, maybe there's another option that you might want to consider. And the other option we maybe suggest that you consider is a partnership MPS service. Now, the way the partnership MPS works is, and AJ Bell are an offer of the service, the way partnership MPS works is it tries to keep all of the good things that come from an in-house advisory model portfolio service, but remove all of that administration headache at not a great additional cost. So the way partnership works is, instead of completely outsourcing your investment solution to an MPS provider or a multi-asset fund, the way partnership works is AJ Bell, for example, would work in conjunction with you to build and design a CIP and a complete investment offering built around your clients. So you get to decide the investment mandate, you get to decide what the target market is, you get to decide all of the important investment policy statement features of the investment offering. And also, in addition to that, you sit on the investment committee meetings where all of the model portfolio discussions take place, and any changes to those model portfolios are only agreed upon between AJ Bell as the MPS provider and you yourself as the advisory practice. Nothing happens to the model portfolio until both parties are in agreement. And what that means is then, as a business with discretionary permissions, we can manage those portfolios on a discretionary basis, removing the administrative headaches that we talked about earlier. But you've now got a portfolio which is very much built around your clients, and you're intimately involved in the design, creation, and ongoing maintenance of those portfolios, but then managed back on an outsourced relationship using reliance on others in order to build portfolios specific for your clients and your client base. Remove all the administration headaches, but you retain all of that chain of conviction stuff that we talked about earlier. And you can see, if you build this on a low-cost platform such as AJ Bell, the fee for this is just 25 basis points, and it is possible to build portfolios that come in between, say, 150 and 200 basis points, all in total cost to the end client. And we think this range of around 150 to 200 basis points will become almost a line in the sand for the FCA. You'll all be familiar with the Dear CEO letter that arrived within your practice at some point around the 23rd or 24th of January. And one of the key features in the Dear CEO letter is around this concept of value for money for end clients. Now, we think all-in cost loads in excess of 2% are likely to be frowned upon by the FCA. Certainly, all-in cost loads of over 250 basis points will be very much frowned upon by the FCA. They are not a price regulator, but we do know that they are looking to bear down on total cost loads for the end client, particularly in a world, as I've just described earlier, where a balanced portfolio is likely to give you a total return of around 6%. It will be indefensible to put a total value chain together which costs closer to 300 basis points, particularly for cautious clients, when a cautious portfolio is likely to give you more like a total return of 3.5% to maybe 4%. It's not fair that we ask these clients to take these risks, and yet the value chain takes up most of the rewards. So partnership MPS might be something of interest, and if it is of interest, have a chat with your business development manager at AJ Bell, and we're more than happy to pick up a conversation there. Now, apologies, that was a shameless plug for a moment or two, and it's not what we do at AJ Bell. We're not here to sell things. What we're here to do is to help. Maybe partnership MPS might be something that helps, but we're here to help everyone regardless of what the investment model is. And so one of the things that we have been working on over the past 6 months or so is a project called Fundamentals, which we intend to launch over the course of Q1. What you'll get with Fundamentals is, as an MPS provider ourselves, we have a team of people in Manchester who research all of the passive industry, and have a team of people in London who research all of the active funds within the sector as well. And as a result of that, we end up with about 120 funds on which we've done all of our initial due diligence, and we maintain ongoing due diligence on all of those solutions. And in a world of PROS and MiFID II, where you have to document all of your research for all of your own model portfolios yourselves, we were conscious that all of the research that we'd done was effectively sat on a dusty server in our offices, awaiting the probable visit of the FCA at some point for us to justify why we build our model portfolios in the way that we do. Well, we've decided to dust off that server, and over the course of Q1, when this goes live, we'll be giving all of that research away for free. So it's absolutely no cost whatsoever. We'll be showing you all of the research that we do on all of the funds that we cover, and you get access to our initial due diligence reports and our ongoing due diligence reports on an ongoing basis, which may help you. It'll be names that you're more than familiar with. It may help you with some of your ongoing DD for the management of your own advisory model portfolios as well. Now, as I said before, we are an MPS provider ourselves, and we build our own model portfolios. Included in the fundamental proposition, we'll be disclosing every single position in every one of our MPS portfolios. So even if you wanted to build your own advisory model portfolios, you might want to take a look at some of our MPS portfolios as maybe a starting template for your own practice as well. So we'll be giving all of our research away, and we'll be giving all of our portfolios away as well. If you want to manage them on an advisory basis, more than happy to help there. Finally, just to wrap things up, I said it a bit earlier on, we think the future of outsourcing within the advisory practices for investments is around the managed or model portfolio service world. But the biggest drawback you've got on this sector at this moment in time is it's really, really difficult in order to do a full whole of market research proposition on all of the MPS providers that are out there. According to our research, there's around 60 MPS providers in the UK, and collectively they manage around 30 billion of assets. Now contrast that with the multi-asset fund world, where there's almost 700 different funds that you can choose from, but there's 200 billion worth of assets managed in multi-asset funds. Now MPS and multi-asset funds are the fastest growing areas of the investment markets. The MPS market last year grew by over 10% and put on over 3 billion of new assets. And the multi-asset fund, if you have a look at any of the Investments Association statistics, it was consistently the fastest growing area of the marketplace. But multi-asset funds have a drawback, and that's a lack of transparency in terms of what's going on with those portfolios and why it's going on. So we believe that more and more advisors will continue to use MPS solutions, but the hard part right now is being able to do that research. There is a system which is called FE transmission, and that allows you to take a look at some of the MPS providers in the marketplace, but it really is impossible right now to do a whole of market research in the MPS world. And that's something we're looking to fix. So this is an AJ Bell sponsored initiative. It is not an AJ Bell company. This is an AJ Bell sponsored initiative. We funded a bunch of computer science graduates and undergraduates to build a platform for MPS providers to list all of their portfolios and all of their portfolio performance in a centralized database. And that's ready to roll. So at this moment in time, we've loaded all of the AJ Bell information onto that platform, and we're in discussions with all of the MPS providers in the marketplace to also load their portfolios onto it. It will be absolutely free of charge to use for advisors. So no cost to use this system whatsoever. You won't need a license in the same way as you need the FE license in order to access the information on their platform. No need to register whatsoever, so you can search and do all your research anonymously as well. You won't be contacted by salespeople who will take notice that you've looked at their portfolios. So completely free of use to all users in the marketplace, and can be used anonymously as well. But just as important is, it will be free of use to MPS providers to list their portfolios and their performance on this platform as well. And so what we anticipate is, having launched this on the 3rd of February as a beta launch, what we anticipate is by the end of Q1, we'll have had discussions with all of the MPS providers in the marketplace. And we anticipate a really high take-up of putting their portfolios onto this platform and making them freely available to you as an advisor to do a whole of market research in the MPS marketplace. So that's just another way in which we're looking to help. This is not an AJ Bell product. It doesn't sit on the AJ Bell platform. It's an AJ Bell sponsored initiative in order to promote the growth and the research of the modern managed and model portfolio services. And that's all from me. Hope that's been a useful 25 minutes or so of your time. Any questions, please feedback using your usual channels. And if you want to discuss any of the stuff that we talked about more, reach out to your BDM and we'll speak to you soon. Thank you very much.